I did. Not at the moment, but I'm actually a little occupied at the moment. Can I return your call a little later? Thanks for your time. Have a good one. Bye-bye. Hello, 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 world. What is going on? What is going on? What is going on? So today, I want to talk about what type of an investor are you? Because, see, we often get a lot of people who will, talk about, oh, I want to invest this, that, and the third. Yet they don't even know what type of an investor they are. So they'll assume that they're actually an investor, when just because you placed money in an ETF, that does not make you an actual accredited investor nor a savvy investor. So today, what I want to do is I'm going to start a little series actually explaining to people the different types of investors, what they are, how to become one, and things of that nature. So we're going to start here today, and we're going to find out what the freak an investor is, period. Because a lot of people think they're investing and they're not. So let's take a look here. An accredited investor. What is an accredited investor? An accredited investor is an individual or a business entity that is allowed to trade securities that may not be registered with financial authorities. They are entitled to this privileged access by satisfying at least one requirement regarding their income, net worth, asset size, governance status, or professional experience. In the U.S., the term accredited investor is used by the SEC, or Securities and Exchange Commission, under Regulation D, to refer to investors who are financially sophisticated and have a reduced need for the protection provided by regulatory disclosure filings. Accredited investors include natural high net worth individuals, banks, insurance companies, brokers, and trusts. So now let's understand accredited investors. Accredited investors are legally authorized to purchase securities that are not registered with regulatory authorities like the SEC. Many companies decide to offer securities to this class of accredited investors directly. Because this decision allows companies exemption from registering securities with the SEC, it can save them a lot of money. This type of share offering is referred to as a private placement. It has the potential to put these accredited investors at a lot of risk. Therefore, authorities need to ensure that they are financially stable, experienced, and knowledgeable about their risky ventures. So what happens is people think, oh, well, I'm going to put some money in the stock market, I'm going to invest, and then I'm going to go make a whole bunch of money, and then I'll be rich. And that's not how it works. First of all, there's something called your risk tolerance. Most people, especially in the African American community, have a zero risk tolerance. What a risk tolerance means is if you decide to day trade or invest your money, let's say in Tesla, as an accredited investor, there's a minimum amount of shares you can buy. Generally, we start with around 100 shares, depending on the price. There's also the commission that you'll pay to the stockbroker, which if you're a newbie investor and I'm trying to earn your business, is going to be around $10,000. So you're starting with having this amount of money or risk that if you can't lose $10,000 or $100,000 and sneeze at it like it's nothing, then you ain't got no business investing. So when companies do decide to offer their shares to accredited investors, the role of regulatory authorities is limited to verifying or offering the necessary guidelines for setting benchmarks to determine who qualifies as an accredited investor. Regulatory authorities help determine if the applicant possesses the necessary financial means and knowledge to take the risks involved in investing in unregistered securities. Accredited investors also have privileged access to venture capital, hedge funds, angel investments, and deals involving complex and higher risk investments and instruments. For example, someone the other day did not understand what I meant when I said street money. Okay? If you're talking to a financial professional and they say street money does not mean money that you and your homeboy made off of selling kilos of drugs. That's illicit money. That's dirty money. That's illegal money. When wealthy people talk about street money, we don't mean money that you've made in the streets illegally. It just means that it may be a transaction that doesn't involve a bank. For example, if someone wants to loan $100,000 of their personal money to another person, they can do so. That would technically be street money. So requirements for accredited investors. The regulations for accredited investors vary from one jurisdiction to the other and are often defined by a local market regulator or a competent authority. In the U.S., the definition of accredited investors is put forth by SEC Rule 501 of Regulation D. To be an accredited investor, a person must have an annual income exceeding $200,000, $300,000 if you're married, for the last 2 years, with the expectation of earning the same or higher income in the current year. So that means if you, a single male, make $199,999 a year for the past 2 years, you are still unable to invest as an accredited investor because you have not made $200,000 a year for the past 2 years and going to make that same money the following year. So, an individual must have earned income above the thresholds, either alone or with a spouse over the last 2 years. The income test cannot be satisfied by showing 1 year of an individual's income and the next 2 years of a joint income with a spouse. So what that means is you can't have, made a $200,000 this year and then, make $150,000, but your wife makes, $50,000. So now you're at $200,000. No, you're not an accredited investor. You have to have that for a solid 3 years straight. So this also goes back to when Kevin Samuels speaks to us about high value. And brother, I'm high value. I make $10,000 a month. How long you been doing that? If you ain't been doing it, and Kevin Samuels says 5 years for you to be high value. This is just allowing you to actually invest like you say you want. So a person is also considered an accredited investor if they have a net worth exceeding $1 million, but that can't include real estate. Net worth exceeding $1 million, either individual or jointly with their spouse. The SEC also considers a person to be an accredited investor if they are a general partner, executive officer, or director for the company that is issuing the unregistered securities. An entity is considered an accredited investor if it is a private business development company or an organization with assets exceeding $5 million. Also, if an entity consists of equity owners who are accredited investors, the entity itself is an accredited investor. So yes, companies do invest. This is how people like ourselves are able to go to apps like Stash, Acorn, companies like Vanguard or Fidelity and think we're investing. That's called an ETF. You're not investing in corporate stock. You should know what you're getting into if you're going to get into it. It sounds fancy, and then you lose all your French toast of money. However, an organization cannot be formed with the sole purpose of purchasing specific securities. So you can't come together as a group in order to buy stocks and bonds. If a person can demonstrate sufficient education or job experience showing their professional knowledge of unregistered securities, they too can qualify to be an accredited investor. So that would be something like your licensed insurance agent, your licensed stockbroker who holds or your licensed mutual fund salesman who holds a Series 6, or your licensed stockbroker, which now they call financial advisor, who holds a Series 7. In 2016, the U.S. Congress modified the definition of an accredited investor to include registered brokers and investment advisors. So it's also important to note that on August 26, 2020, the U.S. Securities Exchange Commission amended the definition of accredited investor. According to the SEC's press release, the amendments allow investors to qualify as accredited investors based on defined measures of professional knowledge, experience, or certifications, in addition to the existing tests for income and net worth. So the amendments also expand to the list of entities that may qualify as accredited investors, including by allowing any entity that meets an investment test to qualify, among other categories. The SEC now defines accredited investors to include the following: individuals who have certain professional certifications, designations, or credentials, individuals who are knowledgeable employees of a private fund, and SEC and state registered investment advisors. So what is the purpose of accredited investor requirements? Well, remember I told you about that risk tolerance. So again, that risk tolerance is if you're going to be an investor, are you going to put $10,000 into that fiduciary's hand and then hope that that $10,000 makes you money? Because that's what people are doing when they're investing, right? No, wealthy invest to preserve capital. But we'll talk about that in another video. But your average American is putting money into the stock market hoping to make $1. The problem that you don't think about is more people lose money in the stock market than make money. Are you comfortable putting $10,000 into the stock market and it going to zero and you having to deal with that? See, most people are not. So most people have no business investing because most people don't even know what type of investor they are. Most people have not gone through a risk tolerance check. I think my next video will be about how one tests their risk tolerance. So the purpose of an accredited investor requirements. Any regulatory authority of a market is tasked with both promoting investment and safeguarding investors. On one hand, regulators have a vested interest in promoting investments in risky ventures and entrepreneurial activities because they have the potential to emerge as multi-baggers in the future. Such initiatives are risky. may be focused on concept-only research and development activities without any marketable product, and may have a high chance of failure. If these ventures are successful, they offer a big return to their investors. However, they also have a high probability of failure. On the other hand, regulators need to protect less knowledgeable individual investors who may not have the financial cushion to absorb high losses or understand the risk associated with their investments. Yeah, man, Tesla sounds great. It's at $1,600. Tesla sounds great. I'm going to buy a bunch of it. I'm bearish on Tesla. Well, they got the space race in it. Okay, well, they got, besides the cars, they have the battery. Samsung already cornered the market in ion technology with the battery. Well, they got the space race. Virgin already got there, Richard Branson. And if this new Minecraft-looking truck doesn't sell through, then they don't have the funds for the other things. So then Tesla crashes. So those people who put a bunch of money in are happy that it's tying to the S&P 500 right now are still gasping and holding their breath. Most unsavvy investors worry about watching the market daily and don't even know what they're watching when they're looking at squawk on the street or looking at the ticker symbols. So, therefore, the provision of accredited investors allows access for both investors who are financially well-equipped as well as investors who are knowledgeable and experienced. There is no formal process for becoming an accredited investor. Rather, the onus is on the sellers of such securities to take a number of different steps in order to verify the status of entities or individuals who wish to be treated as accredited investors. See, what this is sounding like, especially in Black America, it's sounding like a bunch of folks who want to call in the Kevin Samuels show like these women and be like, well, isn't there any hope? Is there no hope? Right? Because right now it's sounding hopeless for a lot of these folks. I made $360,000 this 1 year. Great. Do it 2 more times, then come talk to me. So, individuals or parties who want to be accredited investors can approach the issuer of the unregistered securities. The issuer may ask the applicant to respond to a questionnaire to determine if the applicant qualifies as an accredited investor. The questionnaire may require various attachments, account information, financial statements, a balance sheet to verify their qualification. The list of attachments can extend to tax returns, W-2 forms, salary slips, and even letters from reviews by CPAs or their tax attorneys, investment brokers, or advisors. Additionally, the issuers may also evaluate an individual's credit report for additional assessment. So if you have bad credit, I don't want to hear the word investment coming out of your mouth, because that 20% that you're beholden to that credit card company, that's guaranteed. That $16,00 that Tesla's currently at is not guaranteed to grow. So you're not guaranteed to make anything off of that. Example of an accredited investor. For example, suppose there's an individual whose income was $150,000 for the last 3 years. They reported a primary residence value of $1 million with a mortgage of $200K, a car worth $100K, outstanding loan of $50K, a 401K account with $500,000, savings account with $450K. While this individual fails the income test, they are an accredited investor according to the test on net worth, which cannot include the value of an individual's primary residence. So that $1 million house, see, they put it in there to confuse you, because people who are not a financial professional would look at this and say, well, yeah, he's got, $150,000 a year for the last 3 years in $1 million house. What ended up adding to that net worth was the 401k worth $500,000 and the liquidity of $450,000 in the bank. Okay? So it says net worth is calculated as assets minus liabilities. They didn't even mention any life insurance, because if you have $1 million house and you have a $2 million life insurance policy, but your mortgage is $1 million, but your life insurance is $2 million, oh yeah, your net worth is still $1 million, because life insurance is an asset. Anyway, net worth is calculated as assets minus liabilities. This person's net worth is exactly $1 million. This involves a calculation of their assets, other than their primary residence, of $1.05 million, or $100,000 plus $500,000 plus $450,000, less a car loan equaling $50,000. Since they meet the net worth requirement, they qualify to be an accredited investor. So now there are some strategies that you want to note to help maximize your income. So a strategic approach to investing can help you maximize your retirement income while minimizing your investment taxes. With no commissions and no financial incentives, Vanguard Personal Advisor Services can help a goal-driven plan to help you to do just that. You'll also have access to personal service at a low cost. So what they're telling you is to go to, Vanguard, E-Trade, or Fidelity, or do it yourself, right? And that's great to tell you to do it yourself. But the reality is this. I know how to cook, and I can cook. But if you gave me the exact recipe that my friend who just left yesterday, she is a chef. She cooked for me and my wife a beautiful, huge pork chop, mashed potatoes, spinach, some kind of apple au jus. And she gave me the recipe, but guess what? With that exact recipe, even if I follow it to the T, it still won't come out the same, because she actually knows the actual way to cook it properly. Now, yes, it's going to come tasting good, but it ain't going to taste like a top chef made it. Just like you would not go on YouTube and learn how to cut your own hair, you would not then go to you wouldn't go to the barbershop and say, yeah, bro, I ain't worried about you. I bought my own clippers. I just need your mirror. Let me go ahead and cut my own hair. You'd zeke yourself. It wouldn't be even. So please do not diminish a financial professional, because they have the license and the schooling for a reason. So that's going to be it for today. There are other types of investors, but I'm going to break this down to you for, the absolute easiest and minimalist way that I can break it down for you. So after we learn about the accredited investor, the next thing we're going to start learning about is a non-accredited investor. And then my next video after that will teach you how to become an accredited investor. Okay, so this is an article from, ironically enough, August 27th, 2020. Now, August 26th, 2020, they finally advised, the SEC, or Security and Exchange Commission, finally made it that a licensed individual in the financial world is an accredited investor. Now, I would continue this, but I've been going for a half hour so far. So I haven't been going for a half hour yet. So you know what? Let's continue. Let's figure out what a non-accredited investor is. See how long this article is. After this, I will stop. So what is a non-accredited investor? A non-accredited investor is any investor who does not meet the income or net worth requirements set out by the Securities and Exchange Commission. The concept of a non-accredited investor comes from the various SEC acts and regulations that refer to accredited investors. An accredited investor can be a bank or a company, but it's mainly used to distinguish individuals who are considered financially knowledgeable enough to look after their own investing activities without protection from the SEC. The current standard for an individual accredited investor is a net worth of more than $1 million, excluding the value of their primary residence, or an income of more than $200,000 annually, or $300,000 when combined with a spouse. A non-accredited investor, therefore, is anyone making less than $200,000 annually, less than $300,000 including a spouse, which is why Uncle Joe Biden did that tax on $400K or better. See, it's all a game. It's a money game, Black America. See, they say that they talk a little fast, but you ain't got to slow down if you speed up for you to catch up. Boop. That also has a total net worth of less than $1 million when their primary residence is excluded. So understanding non-accredited investors. Non-accredited investors make up a bulk of the investors in the world. When people speak of retail investors, they often mean non-accredited investors. Basically, this term covers everyone that holds less than $1 million in assets, aside from the value they may have in their house, and earns under $200,000 a year, i.e., the vast majority of Americans. You're average at best. Oh, he said that. You shouldn't have said that, sir. That's mean. Even though those numbers are not as far away as when the definition was set, accredited investors are still in the 95th percentile, according to 2015 stats from the U.S. Census Bureau. The SEC does have the ability to change the definition of accredited investor should inflation or other factors result in too much of the general population meeting this standard. Non-accredited investors in private companies. Non-accredited investors are limited in their investment choice for their own safety. After the speculation around the 1929 crash, so less than 100 years ago, remember, the stock market completely crashed, and the resulting depression, the SEC was created to protect regular people from getting into investments that they couldn't afford or understand, which sounds like the vast amount of people I talk to who then diminish life insurance and run to Tesla because it's attached to the S&P 500 when I can show you a life insurance policy, because life insurance companies have been dividend paying, which is something that stocks sometimes do, for over 100 years. The SEC uses acts and regulations to set out what a non-accredited investor can invest in and what those investments need to provide in terms of documentation and transparency. Private funds, private companies, and hedge funds can do things with investor money that mutual funds cannot, simply because they deal primarily with accredited investors. The SEC assumes that all parties involved know the risks and rewards involved, so they have a lighter regulatory touch where these funds are concerned. That said, these funds must pay close attention to their compliance and make sure that their investor counts stay within the rules, because they can lose their regulation status. For some types of private investment, they are only allowed non-accredited investors when they are employees or fit a specific exemption. Other funds and companies can have unrelated non-accredited investors, but they must keep the number below a certain level. This is the case with Regulation D, which keeps the number of non-accredited investors in a private placement below 35. Save more for retirement with the right financial advisor. The right financial advisor can help you reach your long-term financial goals. This here has some free tools that can help you match with your fiduciary financial advisor. So that is a non-accredited investor versus an accredited investor, ladies and gentlemen. So, like I said, I've been going for the last half hour. If you're here, you're here. If you're not, you're not. I'm sure some of you have gotten some good information from this, because a lot of you out there probably didn't want to hear this because you found out you're a non-accredited investor and that your multi-million-dollar house doesn't help your net worth test to be a true investor. And if you lose some money, you probably can't deal with that. So at any rate, with that being said, peace and Black power, one love, I'm out.